Welcome to Occidental's fourth quarter 2021 earnings conference call. All participants will be in listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your touchtone phone. To withdraw your question, please press star then 2. Please note that this event is being recorded. I would now like to turn the conference over to Jeff Alvarez, Vice President of Investor Relations. Please go ahead.
Thank you, Rocco. Good afternoon, everyone, and thank you for participating in Occidental's fourth quarter 2021 conference call. On the call with us today are Vicki Hollub, President and Chief Executive Officer, Rob Peterson, Senior Vice President and Chief Financial Officer, Ken Dillon, President, International Oil and Gas Operations, and Richard Jackson, President, Operations, U.S. Onshore Resources and Carbon Management. This afternoon, we will refer to slides available on the Investors section of our website. The presentation includes a cautionary statement on slide 2 regarding forward-looking statements that will be made on the call this afternoon. I'll now turn the call over to Vicki. Vicki, please go ahead.
Thank you, Jeff, and good afternoon, everyone. The fourth quarter of 2021 was a fitting way to end the year where Oxy's operational and financial performance advanced from strong to stronger. Our focus on consistently delivering outstanding operational results, combined with our steadfast dedication and patience in improving our balance sheet, has positioned us to begin increasing the amount of capital returned to shareholders. Our new shareholder return framework, which we will detail today, includes a dividend that is sustainable in a low-price environment. We are pleased to implement this new framework, beginning with an increase in the quarterly common dividend to 13 cents per share. The position of strength that we are in today stems from our team's hard work and accomplishments last year. Throughout 2021, we strived tirelessly to improve our already exceptional operational performance. We capitalized on efficiency improvements by embedding innovative techniques across our operations. Our focus on learning, implementing change where needed, and maximizing opportunities for improvement enabled us to accelerate time to market for our products while generating notable capital savings. We will continue to maximize operational efficiencies in 2022 by executing on a capital plan that invests in our highest return assets to generate long-term sustainable free cash flow. This afternoon, I will begin by covering our fourth quarter and full year 2021 highlights and achievements before detailing our 2022 capital budget. Rob and I will then discuss our shareholder return framework, and Rob will provide guidance for the first quarter and year ahead. Before turning to Q&A at the end, I will provide a preview of the Low Carbon Ventures investor update that we have planned for next month. Now to talk about delivering cash flow priorities. Those who have followed us in Oxy's journey over the past several quarters know that our cash flow priorities have centered around de-risking our balance sheet and reducing debt. We diligently delivered on these cash flow priorities throughout 2021, including the repayment of approximately $6.7 billion of debt. We now expect that our net debt will be below $25 billion by the end of the first quarter of 2022, which will mark a change in how excess cash flow will be allocated going forward. Before I detail our updated cash flow priorities and shareholder return framework, I would like to first touch on a few of the many operational and financial successes that enabled us to reach this significant turning point. 2021 was a year of continuous operational improvements, which drove record free cash flow generation, rapid debt reduction, and a return to profitability. One of Oxy's core strengths is our ability to develop assets in a way that efficiently maximizes production and recovery while generating significant cash flow. And that is just what we did in 2021. Multiple drilling and completion records were set across our domestic and international businesses as our production for the year averaged 1.167 million BOE per day. That's 27,000 BOE per day higher than our initial guidance. 2021 was also a more conventional year in terms of commodity prices, operations, and planning, all of which was helpful in providing a reserve update that reflects a more normalized price environment. Our reserves for year-end 2021 increased to 3.5 billion BOE, representing a reserve replacement ratio of 241%. Our reserves position means that we have a vast supply of low break-even projects and inventory available. We have included updated inventory information for our U.S. onshore operations in the appendix to this presentation. Over the last year, we significantly advanced our commitments toward a low-carbon future. We are proud to be one of only a few oil and gas companies with net zero goals that are aligned with the Paris Agreement's 1.5 degrees Celsius pathway. In December, Oxy became the first U.S. upstream oil and gas company to enter into a sustainability-linked revolving credit facility, which includes absolute reductions in our combined scopes 1 and 2 CO2 equivalent emissions as the key performance indicator. We set additional interim emission targets to further refine our net zero pathway, including a short-term target to reduce our CO2 equivalent emissions to approximately 3.7 million metric tons per year below our 2021 level, and to accomplish that by 2024. We set a medium-term target to facilitate the geologic storage or use of 25 million metric tons per year of CO2 in Oxy's value chain by 2032. We also endorsed the Methane Guiding Principles and Oil and Gas Methane Partnership 2.0, a climate and clean air coalition initiative led by the United Nations Environment Program. This is consistent with our commitment to enhance methane emissions reporting and reducing those emissions. Our journey towards net zero is underway, and we look forward to discussing in greater detail at our Low Carbon Ventures Investor Day next month. Now to fourth quarter highlights. The strong operational and financial performance that we delivered throughout last year continued in the fourth quarter. We set a fourth consecutive record for quarterly free cash flow generation before working capital, which contributed to generating our highest ever annual level of free cash flow in 2021. We continued to apply free cash flow toward reducing debt and strengthening our balance sheet, repaying an additional $2.2 billion of debt in the fourth quarter. Operationally, all three business segments excelled in driving our robust financial performance. OxyChem delivered record earnings for the second consecutive quarter, as performance throughout the year culminated in 2021 being OxyChem's strongest in over 30 years. Fourth quarter, which is typically lower due to seasonality, even exceeded the record third quarter. And in our oil and gas segment, our Permian, Rockies, and Oman teams set new operational records and efficiency benchmarks in the fourth quarter, further improving on their third quarter records. Our midstream business outperformed by maximizing gas margins during the fourth quarter. While short-term opportunities in the commodity markets are difficult to predict, our midstream team excels at finding and taking full advantage of such opportunities when they arise. Now, I'm pleased to say that our fourth quarter results continue to demonstrate the commitment of all of our employees, no matter their position or location, to find ways to further create value by lowering costs, improving efficiencies, and maximizing recoveries. They truly are driving our strong financial results and providing a solid foundation for free cash flow generation. Now on to 2021 oil and gas operational excellence. On each of our last several calls, I've enjoyed highlighting the many operational achievements our teams continuously deliver. The magnitude of these achievements is striking when viewed on a combined basis over the last year. We established record drilling cycle times in the Gulf of Mexico, the Permian, Rockies, and in Oman, and set new efficiency benchmarks across our portfolio in 2021. We intend to maintain our focus on continuous improvement in the year ahead as we work to maximize the value our portfolio can generate for shareholders. Now our 2022 capital plan. Our 2022 capital plan invests in cash flow longevity while building on the capital intensity leadership we demonstrated in 2021. We have sized our capital plan to sustain production in 2022 at 1.155 million BOE per day, while investing in high return projects that will provide cash flow stability throughout the cycle. We have also incorporated an expectation for inflation and a capital range to reflect the potential for fluctuations in our third-party operated assets and our low-carbon opportunities during the year. Our sustaining capital, which we define as the capital required to sustain production in a $40 WTI environment over a multi-year period, remains industry-leading. Our multi-year sustaining capital is expected to increase from our 2021 capital budget of $2.9 billion to a reduced inventory of drilling uncompleted wells and additional investment in our Gulf of Mexico and EOR assets to optimize the long-term productivity of our reservoirs and facilities. If the macro environment requires spending below our multi-year sustaining capital, we have the ability to reduce it further and hold production flat for shorter periods of time, as we've demonstrated. We're also investing in attractive mid-cycle projects that will provide cash flow stability through the cycle in future years. For example, these projects include the Al Hosn expansion, which began last year, and OxyChem is in the process of completing a FEED study to modernize certain Gulf Coast chlor-alkali assets from diaphragm to membrane technology. Our capital plan also includes investments to advance our net zero pathway, including reducing emissions, improving energy efficiency, and developing our carbon sequestration initiatives. We're allocating capital in the budget to 1.5 to begin construction on the first direct air capture facility. We continue to make progress on both the engineering and commercial needs for direct air capture development. We're improving both of these aspects and believe Oxy's capital helps retain value for our shareholders. As the construction phase and technology of this new project advance, we will continue to consider strategic capital partnerships and structures to address financing. We'll provide more comprehensive update on 1.5 and direct air capture at our March 23rd LCD investor update. We benefited greatly from commodity price rebound last year and appreciate how swiftly the price environment can change. The optionality that our scale and asset base provide enables us to retain a high degree of flexibility in our capital and spending plans. The majority of our capital program is comprised of short cycle investments, meaning that we have the ability to quickly adapt to changes in the macro environment. Within 6 months or less, if necessary, we can reduce capital spending to sustaining levels. And if oil prices remain supported this year, our intent is to follow our cash flow priorities and capital framework that we will share with you today. We have no need and no intent to invest in production growth this year. Having a flexible capital budget that includes investment and cash flow longevity provides us and puts us in a stronger position to implement shareholder return framework that will benefit shareholders over the long term. With respect to cash flow priorities, our priorities for 2022 remain largely unchanged, with a continuing emphasis on reducing debt while maintaining our asset-based integrity and sustainability. The objective of strengthening our financial position remains the same, to enable us to confidently increase the amount of capital that we may sustainably return to shareholders throughout the cycle. As we expect net debt to fall below $25 billion by the end of the first quarter, our focus has expanded to returning capital to shareholders, beginning with the increase in our common dividend to 13 cents per share and the reactivation and expansion of our share repurchase program. The increase in the dividend to 13 cents per share is consistent with our intention to initially increase the dividend to a level that approximates the yield of the S&P 500. We believe establishing framework for returning capital to shareholders through a sustainable common dividend, combined with an active share repurchase program and continued debt reduction, creates an attractive value proposition for shareholders while also improving the company's long-term financial position. For the first phase of our shareholder return framework initiated, we have the option in future years to invest in cash flow growth. We have the ability to grow oil and gas cash flow through higher production, but also have multiple investment opportunities across our other businesses. As evidenced by our guidance for 2022, we do not intend to grow production in 2022. At the point where it is appropriate to invest in future cash flow growth, we will only do so if supported by long-term demand. Any future production growth will be limited to an average annual rate of approximately 5%. I'll now turn the call over to Rob, who will walk you through our shareholder return framework.
Thank you, Vicki, and good afternoon. As Vicki mentioned, the first phase of our shareholder return framework consists of debt reduction, an increase in the common dividend to 13 cents per share, and the reactivation and expansion of our share repurchase program. With net debt expected to be below $25 billion by the end of the first quarter, we are ready to begin returning more capital to shareholders, but will continue to prioritize debt reduction to focus on our medium-term goal of regaining our investment-grade credit rating. We place high importance on debt reduction for the reasons I highlighted last quarter, mainly that as debt is reduced, our company's enterprise value will rebalance to the benefit of our shareholders. We recognize that oil prices are uncertain and may remain volatile, particularly in the current environment. We intend to prioritize the retirement of additional $5 billion of debt to drive our net debt towards our next milestone, $20 billion. When this milestone is achieved, our balance sheet will improve significantly, even from where we are today. We intend to provide our shareholders with a competitive common dividend while maintaining a long-cycle cash flow break-even at $40 WTI or less. The long-term sustainability dividend will be enhanced by continued deleveraging and share repurchases, as well as our best-in-class capital efficiency and a deep, low-cost portfolio of assets. As debt is retired, our cash interest payments will decrease, freeing up cash that can be used to support future common dividend growth. In addition to increasing the common dividend 13 cents per share, we intend to purchase approximately $3 billion of outstanding shares of common stock. Maintaining an active share repurchase program with the benefit of a healthy balance sheet will potentially enable us to grow the dividend on a per-share basis at a faster rate. As evidenced by our progress reducing debt last year, debt retirement remains a higher cash flow priority than share repurchase program. We intend to make substantial progress towards retiring an additional $5 billion of debt before initiating share repurchases. It is our goal to reward shareholders with the triple benefit of a sustainable common dividend, an active share repurchase program, and a continuously strengthening financial position. We believe the shareholder return framework we have detailed this afternoon delivers these benefits in a manner that is transparent for shareholders. I'll now turn to our fourth quarter results. In the fourth quarter, we announced an adjusted profit of $1.48 and a reported profit of $1.37 per diluted share. Our adjusted income improved significantly through 2021, with the fourth quarter being the strongest quarter of the year. The increase in earnings was primarily driven by higher commodity prices and volumes, as well as OxyChem's excellent financial performance. Our domestic oil and gas expenses experienced a sizable reduction on a BOE basis from the previous quarter and reflect a more normalized environment, absent any significant weather disruptions. The strong performance of our businesses, combined with the benefit of a healthy commodity prices, enable us to deliver another consecutive quarter of record free cash flow. On our third quarter call, we announced the completion of our large-scale divestiture program, but reiterated our intention to continue seeking opportunities to optimize our portfolio to create shareholder value. In November, we completed a bolt-on acquisition to increase our working interest in EOR assets that we operate. And in January 2022, we divested a small package of Permian acreage that we had no immediate plans to develop. The purchase and sale prices of these transactions largely offset each other, while the EOR acquisition added approximately 5,000 BOE per day of low-decline production, as well as increasing our inventory of potential CCUS opportunities. We exited the fourth quarter approximately $2.8 billion of unrestricted cash in the balance sheet after repaying approximately $2.2 billion of debt in the quarter. In total, last year, we paid approximately $6.7 billion of debt and retired $750 million of notional interest rate swaps. Our debt reduction continues to drive a pronounced improvement in our credit profile. Since our last call, both Fitch and S&P upgraded our credit ratings to BB+, one notch below investment grade, while Moody's assigned us a positive outlook on our debt. Reducing the amount of cash that is committed to interest payments today places us in a stronger position for a sustainable return of capital in the future. We estimate that the balance sheet improvements executed in 2021 will reduce interest and financing costs by almost $250 million per year going forward, which will fund approximately half the increase in our common dividend. Our business incurred a negative working capital change in the fourth quarter. It was primarily driven by a higher accounts receivable balance due to higher commodity prices, and to a lesser extent, an increase in inventories, including a higher number of barrels on the water at year-end. The oil and gas hedges we had in place rolled off at the end of the fourth quarter. We are now positioned to take full advantage of the current commodity price environment. We recognize the possibility of a swift change in commodity prices always exists. The debt maturity profile we have today is far more manageable than it was 2 years ago, and our liquidity profile remains robust. In addition to cash on hand, we have $4.4 billion of committed, unutilized bank facilities. We continue to believe that reducing debt and maintaining maximum flexibility in our capital plans is the most effective long-term strategic solution to managing risk while providing shareholders with the benefits of commodity price gains. We expect our full year production to average 1.155 million BOE per day in 2022. Production in the first quarter of 2022 is expected to be lower than the fourth quarter of 2021 due to the timing impact of wells that were brought online in 2021, severe winter weather in the Permian earlier this month, and the impact of significant planned international turnaround activities this quarter. Algeria, Al Hosn, and Dolphin are all undergoing scheduled maintenance in the first quarter, which is reflected in our national production guidance. The downtime associated with Al Hosn is notably larger than typical years, as the plant is undergoing the first full shutdown since its inception to substantially complete the tie-ins associated with the expansion project and to enhance plant stability, sustainability, and reliability. Additionally, a portion of our international production is subject to production sharing contracts, where we typically receive fewer barrels in a higher price environment, the impact of which is captured in our full year and first quarter guidance. The Permian activity we added late in the fourth quarter is expected to replace the production benefit we received in 2021 and completing our inventory of DJ Basin undrilled uncompleted wells in the early part of last year. Our 2022 Permian capital allocation is expected to provide benefits that will last into 2023. We anticipate that our activity this year will provide us the flexibility to either hold Permian production flat at our 2022 exit rate for similar capital next year, or spend less capital in 2023 to hold production relatively flat to our 2022 average. We also expect that our production in 2022 will increase throughout the year to achieve our full year guidance as our international operations will resume their normal production levels and our activity in the Permian brings new production online. Additionally, the trajectory of our Permian production is anticipated to offset lower production in the Rockies this year as our activity in the DJ Basin is tapered, to reflect the development planning timing to ensure efficient operations as new permits are obtained. Partially offsetting lower Rockies production with higher Permian production, combined with an increase in EOR activity, will result in a slightly higher domestic operating expense, as the DJ Basin has one of the lowest operating costs on a BOE basis in our portfolio. The increase in Permian production is expected to result in domestic cash margins improving in 2022 as the company-wide oil cut increases to approximately 54.5%. Mid-cycle level of capital we intend to spend this year provides flexibility to sustain production in 2023 and beyond at our multi-year sustaining capital level of $3.2 billion in a $40 price environment. We expect that OxyChem's 2022 earnings will exceed even 2021. OxyChem continues to benefit from continued demand improvement for caustic soda, while PVC pricing remains strong. Additionally, as I mentioned in our last call, we expect chlorine markets to remain tight as chlor-alkali producers seek the highest value for their products. OxyChem's integration across multiple chlorine derivatives enables us to optimize our production mix to supply the products the market requires, whether this is for chlorine for water treatment, vinyls, or PVC, for example. This year, we will make an incremental capital investment as we complete a FEED study for the modernization of certain Gulf Coast chlor-alkali assets from diaphragm to membrane technology. Modernizing these assets would result in a material energy efficiency improvement, which would also lower the carbon intensity per ton of the product produced and delivered. The project would also provide the opportunity for a significant expansion of our existing capacity to meet growing demand for our key products. We expect to reach final investment decision later this year, at which time we will be prepared to share additional details. To assist investors with reconciling our guidance with our segment earnings, we have made a change in how we guide midstream going forward. Our midstream guidance now includes income from West, which is a change to how we've guided midstream previously. Quarterly guidance now includes Oxy's portion of West income using the average of the previous 4 publicly available quarters. Our annual guidance now includes Oxy's portion of West income using the sum of the previous 4 publicly available quarters. As we look to the year ahead, we will work to continue to improve on the numerous operational and financial success of 2021, including making additional inroads on reducing debt, implementing a shareholder return framework, and advancing our low carbon aspirations. I will now turn the call back over to Vicki.
Thank you, Rob. When we established Low Carbon Ventures in 2018, we knew we were ahead of the curve in recognizing the opportunity and necessity of building a carbon management business, both to help reduce global emissions and to enhance our business. At that time, we were focused on key technologies and projects that would reduce Oxy's emissions and provide a more sustainable future business. Today, we have advanced that vision and fully appreciate the vast scope of the carbon management opportunity, as well as the cross-industry support and partnership in front of us. On past earnings calls, we have discussed several of the initiatives Low Carbon Ventures is developing, and Oxy's ambition to achieve net zero before 2050. We've been working on key technology developments and important commercial needs to advance LCV's projects and are now in a position to move more fully detail our low carbon business and how it positions us to realize our net zero ambition and improve our long-term business. On March 23rd, we will host a Low Carbon Ventures investor update where we will provide a detailed update on our low carbon strategy with a focus on the technology and commercial development of carbon capture projects, specifically direct air capture. The event, which we expect may last up to 2.5 hours, will be accessible through our website. As I've said before, we are excited about our unique position and capabilities as a company. We value our broader low carbon and business partnerships that are growing, and our workforce is energized to advance this immense opportunity before us. We'll now open the call for your questions.
Thank you. We will now begin the question and answer session. To ask a question, you may press star then one on your touchtone phone. If you are using a speakerphone, we ask that you please pick up your handset before pressing the keys. To withdraw your question, please press star then two. Today's first question comes from Jeanine Wei with Barclays. Please go ahead.
Hi, good morning, good afternoon, everyone. Thanks for taking our questions.
Thank you.
Good morning, or afternoon. It's been a long week. Our first question is on the gross debt reduction. We're assuming that the $5 billion that you're planning on getting through, that can be executed through tenders. And so just any idea on what the timing of that could look like for you to complete that, given what you've seen in the market? And do you need to get through the full $5 billion of tenders before you begin the buybacks? We were looking back at your prior tender, and you almost got the full thing done, but that was only about $1.5 billion.
Yeah, good question, Janine. And so I guess first let me comment on the tender that we did at the end in December. You know, we were pretty aggressive on the premiums we put in that tender because we knew we had an additional $700 million of callable debt available to us at the time. And so we were pretty happy with the ultimate outcome that came out of that. As we move forward since then, you know, we have a lot of opportunities to reduce the debt. You know, last year we were able to reduce, of the $6.7 billion of debt we did last year, we only paid a 1.5% premium for that. And within that, 4.7 of that was actually concentrated in maturities that were 2024 or newer. And so when I look at the opportunities to retire debt this year, you know, as we indicated, we already retired the remaining January, last of our 2022 maturities for $101 million already this month, or this quarter. So we do have tenders, make-whole provisions. We have the ability to build cash on a net debt basis as maturities come forward. We do have the options to settle the February 23 notes, which is the bulk of our 2023 maturities, come callable in November. But overall, when I look at our debt, it is actually even cheaper than it was at the end of the year, largely because as interest rates have risen in the perspective of interest rates rising again. And so certainly the next dollars we put forward will be towards debt reduction. And, you know, with the cash we ended the year at and the cash we're adding during the quarter, it's pretty safe to say that's probably not too far in the future that we initiate that process again. We don't need to have all of that completed before we return to buying we initiate the share purchase program. But we need it to be substantially completed or have line of sight on it being completed before we would begin purchasing shares.
Okay, great. That's really helpful information. Thank you. Maybe just going forward a little bit beyond that on your future cash flow priorities, Oxy's got a real high-class problem. Assuming oil prices stay anywhere close to where they are today, you'll be building a significant amount of cash on the balance sheet over the next 2 years, even after you do the $5 billion of debt reduction and the $3 billion of buybacks. So I guess, have you started to assess the next steps in capital allocation after hitting your debt goals and the buyback? And I guess specifically, do you have any thoughts on potentially trying to tackle the preferreds early and doing that versus either other debt reduction or production growth and just how you're thinking about the preferreds? Thank you.
So, you know, we've discussed previously provisions with regards to the Berkshire agreement related to shareholder return, enabling us to begin redemption of the Berkshire at a $4 per share common dividend to our shareholders. You know, assuming we repurchased $3 billion of shares in a 12-month period, and then you combine that with 52 cents of dividend payments over 4 consecutive quarters, we still want to distribute it enough to reach a $4 per share distribution trigger. It would be about $3.72 at that point. But I want you to say that the Berkshire common provision isn't a limit on our ability to return value to shareholders. It simply means the circumstance arrives and the macro puts us in a place where we have exceeded $4 per share on a trailing 12-month basis. We would just be in a position where we have to redeem an equal portion of Berkshire at a 10% premium as we return to shareholders above and beyond that. And so as we sit here today in February, agreeing that there's a lot of potential for elevated oil prices over an extended period of time that would create a constructive macro for going beyond our debt focus, but it's a little too early, I think, to speculate on what we would do in that point in time.
Thank you. Our next question today comes from Phil Grush at J.P. Morgan. Please go ahead.
Yes, good afternoon. I guess just to follow up on that question around the net debt, the $20 billion next step, so to speak. What is the ultimate goal with the balance sheet? Is it 10 to 15 billion? I mean, how do you think about that today?
Yeah, Bill, I think we've already seen in notes published from the various rating agencies that their expectations would be investment grade is somewhere in the mid to high teens. And so I think getting to that point, getting to a level at some point that is in that $15 billion or less net debt is an ultimate goal for the company. That would put us in a place. It also depends sort of on their long-term price horizon. If you take their $60, the getting down to a net of 20 puts us close to a 2 multiple at that point, depending on EBITDA going on a year in, year out basis. So we know we've got to do a little further than that in order to get consideration for investment grade.
Okay, that makes a lot of sense. Thanks. And then, Rob, you made a comment just about the Permian exit rate in 22 and into 2023. And I was just wondering, where do you stand in terms of the CapEx carry with the Ecopetrol JV? Is there any spending in 2022, that kind of moves into the full 50-50 split, or is that a 2023 event? I'm just curious, based on your comments you're making, how you incorporated how that could flip to the 50-50 and when.
Based on activity level we have planned for this year, we would probably consume the balance of the carry this year, but we don't anticipate carry flipping in 2022.
Thank you. And our next question today comes from Doug Leggett with Bank of America. Please go ahead.
Thanks. Good morning, everyone. Rob or Vicki, I wonder if I could follow up first on the buyback, just so as I understand it correctly. So $3 billion, is that an annual number that, depending on when you start the buyback, would you still expect to execute the full $3 billion in 2022, irrespective of when you get that line of sight, which I'm guessing is a matter of months? And I guess related, you're kind of front-running yourself a little bit. And one could argue taking advantage, the stock is heavily discounted because of your capital structure. Why not consider something like an ASR?
So Doug, I think the first way I'd answer part of your question is once we initiate the share repurchases, it will be done both in a open market repurchase basis when the market's open and when it's closed to a 10b5 type programmatic program. The stock, as you know, is extremely liquid. I mean, we can easily purchase $1 billion of shares in less than 14 trading days without, close to 15% of the average daily trading volume. So there's a pretty safe way that over a fairly short period of time, if we wanted to, we could accomplish $3 billion goal. But that goal will certainly be dictated by our free cash flow generation that's largely related to commodity prices. And it's, we're in an environment right now where the hedges have rolled off. We're giving our shareholders full exposure to commodity prices, which we think over the cycle of the commodities will deliver the most value to the company and ultimately most value to shareholders. But along with that, we realize that the macro can change for a lot of different risk factors that can cause prices to go unconstructive for us in a rapid fashion also. And so we can't find ourselves in a position where maybe we tackled the stock ahead of time and the price environment changed for whatever reason, and we haven't addressed the debt first. That's part of the reason why we understand that over the course of the year, we may end up paying more for the stock to retire it, but in aligning risks and opportunities for shareholders, we think that the approach we're taking is the most prudent way to do it.
Okay, so just to be clear, so if you started the buyback in May, you'd still expect to get $3 billion done this year? That's just for clarity. That's not my follow-up.
Well, the timeline is going to be dependent upon the availability of cash, Doug. That's what's going to be the driver of it. But in terms of ability to execute with the liquidity of the stock, a time frame of being able to complete it in the second half of the year, even if we didn't initiate until the second half of the year, would not be a challenge.
Okay, thank you. My follow-up is a resource question. Vicki, I'm guessing this was deliberate, but you've kind of laid out the inventory depth for the onshore portfolio. Looks at the current rate, something around 15 years, assuming not a lot of growth. What about the Gulf of Mexico and the rest of the portfolio? Can you give us a kind of an update as to how do you see the resource depth or sustainability that goes along with the sustaining capital number that you gave us?
Yeah, I'll let Ken answer that. He's got his team actually working on that in view of some of the challenges we've had with the recent lease sale. Actually, we have a great news story on that.
Morning, Doug. In terms of Gulf of Mexico, we recently completed our field architecture studies. As you know, we have 179 blocks. Around 90 of those are tagged as exploration. When we look at the risk portfolio and the opportunities we have substantial work, hundreds of millions of risk barrels of opportunities going forward. We have a solid assembly line of projects. We've got 3 projects in flight at the moment: Caesar Tonga expansion, Horn Mountain expansion, A2 subsea pumping, and our recent, as Vicki alluded to, our recent lease round attempt. Our goal there was to try and obtain acreage close by our existing infrastructure to accelerate simple tiebacks, but that doesn't inhibit us. We have a large portfolio and we feel comfortable going forward within the plans that have been presented in the slides.
Thank you. Our next question today comes from Neil Mehta with Goldman Sachs. Please go ahead.
Thanks, guys. So the first question is on the production profile. Vicki, you had made the comment that as you think about the long term, you want to see growth somewhere between 0 and 5%. Is that sort of how do you think about the long term profile? And based on the way you view normal, that's a big range. Where do you see yourselves planning in the context of that range?
Well, it really depends on the projects, and what we always do is we try to design our capital programs to deliver the best returns. And so it's always, as we develop our areas, it's always with that in mind, and to build the facilities that require a pace of development that delivers the maximum return. So we could have a little bit lumpy growth going out. The Gulf of Mexico is a little bit lumpy. In the shale play, depending on whether you're starting a new area or not, could be a little bit lumpy. But certainly our capital intensity, we believe, is going to continue over time to be the best in the industry. And the development that we'll have, and whether or not we're at 0 or 5%, will depend on how the program lays out to maximize returns. So we have, as you see, inventory onshore, inventory in the Gulf of Mexico. We have as well some international projects that could add value. And as I mentioned in my script, we do have in our chemicals business opportunities to grow there. And so the efficiencies and opportunities that we see really will depend on how we can piece it together to deliver the best possible return.
Yeah, certainly an evolving situation. Let me ask you about chemicals, Vicki, because the 22 guide was stronger than what we anticipated. I think a lot of investors expected chemicals to be sequentially lower. Just talk about some of the moving pieces that allows for some profitability to improve year over year, and what are the biggest risks to actually achieving the guide?
Yeah, Neil, I'll take the one on chemicals. And so, what I point to first, and I know you understand the business well, is obviously if you look at slide 39 in the deck, the two profit drivers in the business are the PVC business, or the vinyls business, and the caustic soda business. And both of those did materially improve throughout 2021. And when we have favorable conditions in both, the impact to earnings is pretty significant. And so what you're seeing is first, let me just say that where the market is at right now is the PVC business is still quite tight, very tight supply-demand balance. I think operating rates for the industry were 81% in January. Demand was slightly higher in January of 22 relative to January 21, less than 1%, but a little bit better. Producers are attempting to build inventory in PVC right now in advance of outages that are scheduled. But you've got this situation where they already had low inventories, and the pull from the construction sector remains strong. And so you've got attempts to grow inventories while demand is still quite strong. We expect demand to remain strong in the PVC business throughout 2022. There's a very favorable housing starts outlook. Mortgage rates obviously remain pretty low, and the remodeling sector also remains very attractive. And so you can look at the export side of the business. So in January, there's only about 250 million pounds of export, which is about 30% less than 21. And that's reflective of the lack of product available right now. And so we certainly see, you're not going to have an opportunity for inventory to really replenish itself and exports to even return until probably the latter part of the second quarter, when resin supply might be normalized in the wake of outages, assuming there's no unplanned outages for that period. And in the case of the chlor-alkali side, we're seeing a very tight supply-demand market, largely because of production challenges. Operating rates, we think, in the industry are going to be somewhere in the low 80s for the first quarter. There's a lot of planned outages scheduled now in May of 22, but there's been a significant number of unplanned outages still in the industry, impacting product availability. And on the chlorine side, we think we'll see growth at least 3 to 4% this year. Again, all the sector markets are strong with the similar markets to PVC that draw on the chlor-alkali side of the business. And we think that'll be also supplemented by there's improving travel, and then business spending, return to office will drive pulp and paper usage for caustic soda, et cetera. So a lot of things that we think are going to be positive on that. And on the international side of the caustic business, certainly rising natural gas prices and availability in Europe and Asia will have already impacted operating rates of chlorovinyl producers overseas, which is driving up values of that. And so the biggest change here, and why I think there's maybe a surprise, because conditions were so remarkable in 2021, and why would we be guiding something higher than that, is that if you go back and look at the beginning of the year, caustic soda at the beginning of 2021 was still coming out of the really low values at the post-COVID drop in 2020. PVC had recovered very quickly on the construction side, but caustic was dragging its way up little by little out of the lows experienced during 2020. And so caustic prices improved sequentially quarter after quarter throughout 2021, which is why you'll see the earnings for the segment in the fourth quarter, which typically, the first and fourth are the shoulder quarters, and the strong ones are the mid-year, Q2, Q3, but you had double the earnings in this chemical segment in the fourth quarter compared to the first quarter. And so we're coming in with so much more momentum, which is why our guide for Q1 is so strong for the chemical business. And so it's not that we're predicting those conditions persist all the way through the entire year. We're just going to start from a higher point. How long those conditions persist will impact whether that guidance actually could increase the balance of the year potentially if it holds on longer than we're anticipating. We do anticipate that things, as I said, will start to normalize maybe the middle part of the year.
Thank you. And our next question today comes from Matt Portillo with TPH. Please go ahead.
Good morning, all. Just the first question on the DJ Basin. You mentioned in the prepared remarks some timing around permits. Just curious if you could provide some context on the permitting process as it stands today. And is this a good level of development to think about for next year, or should we expect a rebound in the DJ in 2023 as it relates to drilling?
Hi, Matt. This is Richard. I'll take that one for us. So, with respect to permits in the DJ, really have had good progress over the last year is how I would describe it. Just looking at some of the permits in hand, we've had about 46 wells permitted, which takes us through really past half the year. And so what we've really put in place is optionality in our program. So if you dig into sort of our onshore plan for this year, we have plans to pick up a second rig in the year. Really, that's based on confidence with where we're going with our permits. So as you know, last year some changes in terms of the process happened, and so we've been meaningfully engaged over the last year. Importantly, at the stakeholder level in communities, and then now at the state. But we've seen our own pads approved as well as other operators, and I think the feedback that we've received and we continue to work on together is continuing to improve technology and things that we know that can really place us in a good place for development. So I guess in short, we're optimistic. We've got a rig planned to come in the second half of the year, but have optionality within the program to be able to adjust as needed.
Perfect. And maybe a follow-up on the marketing side. I know as an organization, you guys have been very thoughtful about this process through the cycle. The basin, it looks like there's possibly some solutions on the horizon for incremental gas takeaway, and just curious how you all might be thinking about potentially adding to your takeaway portfolio from a gas marketing perspective, and then maybe dovetailing into that on the crude oil side. Can you just remind us when some of those contracts start to roll over, and if there's any tailwinds to the financials kind of moving forward over the next few years around crude oil marketing?
Yeah, Matt, we really have enough gas capacity, and as much as we feel like we need at this point. And with respect to our growth profile, and for the oil side of it, the contracts start rolling off in 2025 for the oil and gas, or for the oil part of the contract. So we have plenty of capacity. At that time, I think it'll take probably a couple of years to get us down to the point where all the contracts roll off.
Thank you. Our next question today comes from Neil Dingman at Truist Securities. Please go ahead.
Morning, all, or afternoon. Vicki, my first question may apply to you. You mentioned just a couple minutes ago here that you thought you maybe would ramp the chemicals, and obviously as a finance guy, that just continues to be. I know when I saw Rob in December, and it just continues to get better and better. I guess my question is, as a financial guy, how much can you grow that, and would that grow in conjunction with your low carbon solution business? I know you've talked about that in the past. I'm just wondering, how much could you push that business, given it just continues to hit the ball off the park on that one?
I think we'll talk about that a little bit more as we talk about the project and the capital that we're executing to convert our diaphragm to membranes, because that's going to improve some efficiency in the areas where we're doing that conversion. So we'll actually be able to increase our capacity, and we'll outline that and detail that a little more in the next earnings call. Because right now we're currently in the process of doing the FEED study on that. For today, with respect to other opportunities, we will continue to consider incoming calls about potential partnerships where it makes sense to do projects with either customers or from the perspective of supporting low carbon ventures. We try to be opportunistic in chemicals and not build without certainly the demand for the product. And so on the low carbon venture side, as we go through this, finding opportunities where there are synergies and growing synergies between the chemicals business and the low carbon business. So it will have some growth around that.
No, that's great to hear. And then just a second, you talked just a minute ago also about the DJ. My thought is it sounds like some of the firm production is going to replace DJ this year. Is that going to be the case going forward? And is that because you're talking about, I know Richard talking about permits and all in shape. I'm just wondering what sort of the reason or rationale for why not just grow both of these? I mean, I'm looking at that.
Yeah, It really just depends on the permitting process, because we do have really good inventory in the DJ Basin as well. And as we go forward and we work out the process, if we get ahead on the permitting, we would consider adding a rig or a rig or two to the DJ as well.
Thank you. Our next question today comes from David Deckelbaum at Cowen. Please go ahead.
Thanks for all the details today, Vicki and team, and congrats on the visibility of $20 billion of debt. I wanted to ask just on the sustaining capital. There were lots of in and outs, particularly around the Gulf of Mexico and EOR catch up, some normalization of Rockies ducks. I guess when we think about that delta between the 2.8 or 2.9 that you guys talked about last year, and the $400 million increment this year, how do we think about that sustaining capital level progressing into the out years now? Does it have some upwards pressure on it because of catch-ups, or should we look at this as a catch-up year and that should moderate, potentially decline, along with base declines moderating?
Maybe we'll start with onshore and speak to that a little bit. I think you've got it right. I think if you look, over the last couple of years and what's happened, certainly 2020 had a significant reset for us in terms of activity levels. And so, preserving cash investment at that point and really dropped activity levels almost completely. And so, coming on the back half and into 2021, we had things like the DUCs in the DJ that allowed us that ability to add production and maximize cash flow for 2021 with a lot less capital investment. And so what happened last year was really, as we think about the transition, it went from transitioning from DUCs as we restored activity really to drilling and completion, which is a much more steady state pipeline for our production delivery. And so the way that played out was really at the end of the fourth quarter, beginning of the first quarter, we were able to pick up our drilling and frac cores to sustain the production for this year, which did a couple of things. One, it was good because as we head into inflationary period, we were able to gain activity and create that stability within our capital program. But what it does is it did create a bit of a lump that we have most of our wells online really starting late in the first quarter, and then you hit more steady state in the second and third quarter. And so as that projects into the end of the year and into 2023, you can tell from our first quarter guide into total year that we do have an increase of production. But those type of events, as well as restoring activity really from a cash investment perspective in EOR, adding low decline production barrels really gives us a much more sustainable production level across the cycle. And so, I think we're restoring, as you said, a much more normal steady state activity level and a much more robust or sustainable free cash flow capability.
I think considering the rest of the portfolio, we don't see a lot of upward pressure for the 3.2 as a whole.
And David, just to add to your point, on top of what Richard and Vicki just went through, from a decline standpoint, as you know, we improved, the base decline from 25% 2 years ago to 22 last year, and it's the same this year. It's at 22% as well. And given the things Richard said, that gives potential to flatten that out a bit in the future.
I appreciate all the color on that. And if I could just ask a quick follow-up, so I'm understanding, there was $400 million, I think, that was attributed to the difference to the low end versus the high end of capital guide, which I think you talked about low carbon ventures spend that would be potential in OBO. I guess for that low carbon ventures spend, would that just be accelerating some projects, or is it a contingency for things that you're considering doing but aren't sure if you want to pursue at this point? I guess, how do we think about that sort of allowance that's built into the difference in the low and the high end?
Yeah, this is Richard again. I think you've got it right from the standpoint of really the LCV capitals certainly focused meaningfully on our direct air capture plant 1. So there is a project timeline associated with that. We're, engineering is going great. The commercial aspects of the project continue to be supportive. And so there's a little bit of uncertainty there, but that component, you know, we'll have more visibility and be able to talk more about even with you next month. In addition to that, what's happened is really beyond strong engineering progress, we continue to have good commercial support, whether that's global policy, recognition for carbon capture, or even direct air capture in particular, or even with strategic net zero businesses. And so these things support commerciality. And so what's happened is we do see additional opportunities for direct air capture. For example, we had an opportunity in Canada to look at with a developer direct air capture with air to fuels. And so a bit of that money is, as these projects become more opportunistic, we would allocate some feasibility capital to be able to look at these other type projects. The final piece is really our CCUS, and you've probably seen some pieces around projects that we're involved with, and so those continue moving beyond into commercial development, and so we have some capital associated to continue those. But you know, that again, be able to share more in March around that, but look forward to these projects advancing meaningfully this year.
Thank you. And ladies and gentlemen, our final question today comes from Raphael Dubois with Societe Generale. Please go ahead.
Hello, thank you very much for taking my questions. The first one is related to your EOR business. Could you maybe tell us a bit more how production in this division has trended since you stopped reporting it as a single entity? And also, I was wondering if the extra capex you will throw at this business is solely to stop decline, or whether you intend to restart growing this business as well.
Maybe I'll start with the EOR just a little bit. You know, as we think about the last couple of years, I'd say the opportunity in front of us really to address, you know, any decline that we've seen is really, and this comes to our OPEX when we talk about that, that's really restoration of maintenance and specifically downhole maintenance. And so the ability to allocate some of that cash investment to restore down production is some of the best cash investment we have. It's very high return, even at mid-cycle prices. And so we expect to be able to, and have added some well service rigs to add up to 6,000 barrels a day by year end. And that really, you know, restores the normal backlog and maintenance schedule that we had, you know, really going back to 2019. So that's the most meaningful change in terms of the EOR business that we're approaching this year.
Excellent. Thank you very much. And my follow-up will be actually on Algeria. I see that you're gonna have some activity there in 2022. I was wondering if you could tell us a bit more what you have in store for this part of the world, knowing that we in Europe are gonna need much more gas from other suppliers, and it would be great if you had some projects, some gas projects in Algeria, for instance.
Hi, it's Ken here. First of all, I'll say the operations team had a great year last year and achieved the 50,000 barrel a day milestone. On the contract side, we spent the time optimizing the future development plans that you're sort of alluding to. And we worked through the legal framework around the new hydrocarbon law, which is designed to encourage foreign investment in the country. This year, we'll drill 4 wells. There'll be 2 injectors, 2 producers. We've now started negotiations with Sonatrach, and we're in the early stages. It's a large American company with state-of-the-art shale capabilities. We think we have a lot to offer the country going forward, and hopefully that helps in Europe also. We'll keep you updated on our progress at the next call.
Thank you. Ladies and gentlemen, this concludes our question and answer session. I'd like to turn the conference back over to Vicki Hollub for any closing remarks.
Before we go, I'd like to say that we stand in firm condemnation of the insane and inhumane actions taken by Putin and Russia to invade Ukraine. Our thoughts and prayers go out to all the people of Ukraine. Thank you all for your questions and for joining our call today.
OK， 这个就结束了。这个 operator 的声音很怪啊。Anyway， 所以我总结一下，我之前在今天白天已经发了一个比较短的视频，讲我看他的财报，在电话会议之前看他的财报，对他的感觉。这种公司，老牌石油公司，所以它的生意其实很 boring 的，就是很无聊，就是非常稳健，就只要油价比较稳定，因为管理层都很有经验，所以它的产量运营效率成本的控制这家公司都没有问题，所以可以想见，在未来我觉得应该是不错的。那这个电话会议给我可能有2点是我之前可能没有特别清楚，至少电话会议里面搞清楚了。第一个就是管理层可能比我原先设想的更为保守，或者是更有纪律性吧，就是他们非常不想提高产量。CEO 表示说，即便未来在油价非常稳定上升的情况下，他们可能每年最多提高5%的产量。所以这个是我之前可能认为他们可能会提高产量更多，现在看起来他的表态不太一样，这是第一个。那第二个就是关于股票回购，我们知道他要一边回购股票一边要增发股息，但是不知道这个顺序。现在管理层基本确定是这样，他们要先完成大概5个 billion 50亿美金的还债之后，把债务的数额总共拉到20个 billion 之下，然后才开始回购。所以大概率的事件就是他们的回购这个3个 billion 30亿美金会发生在今年的下半年，而不会是下个月。所以因此这可能对股价在短期帮助不太大，这是另外一个。然后还有就是我之前在视频讲过，他最终的目标是要把自己的债券的等级上升到投资级别，因为这会对公司估值还有那个利息费用成本有很巨大的好的影响。但 CFO 刚才表态是讲他们最终的目标是把债务减少到15个 billion， 大概这个水平，意味着他即便到了20个 billion 还会继续减。但是这个额外的这5个 billion 今年能不能完成，我觉得这是一个问号，有可能完成，也有可能完不成。所以如果他确认说只有到15个 billion 这个债务水平，那些评级机构才会把西方石油的债券调升为投资级别，那么这个债券的评级的提升有可能在今年的下半年，也有可能会被耽搁到明年上半年。所以这个我之前的想象可能是过早了。如果 CFO 没有特别保守的话，他比较确认华尔街和那些评级机构会等他一直把债务缩减到15个 billion 才会给他升级，那时间可能比我原先设想的要长一些。所以基本上就这些。我们他们公司管理层表示会在大概1个月之后，在3月的下旬会有一个专门的会议，跟投资者沟通他们在低碳事业上要怎么操作，大概需要什么样的资金量，然后至少我们知道他2022年他需要的资金怎么样，因为刚才他在那个 slides 里面已经表示了这部分需要几个 billion 的投资。只有等那个会议之后，我们才大概知道它的时间线是怎么样的，在什么时候能够真正有产出，怎么把这个估值把它反映出来。所以在现在这部分我基本上不予考虑。对这家公司我总体的看法一直没有变化，除非有特别重大特别怪异的事情发生，要不然这是应该是非常稳定的一家长期得看你的风格了。如果我的风格我是为了长期拿到股息，其实我不介意长期持有这样的公司。比如说我原先最早的成本是 每股$10，那我非常确信它在几年之后，每股的股息每年会达到$4以上，所以其实$10成本，每年拿到$4的股息，那光是股息，如果不考虑股票增值的话，光是股息每年就可以有40%的回报，还是很不错的。但我不是这种股息的投资者，所以我很大概率还是会逐渐会出清。但供大家参考了。所以我觉得公司很稳健，然后也没有什么特别意外的事情发生，而且公司管理层至少在回购这一点比我设想的更快，所以我觉得还是不错的考虑。OK， 我们现在有个问题问说 ，CFO 有提过减债速度会有多快呢？现水平 long term debt 应该是29个 billion， 不是的，它现在long term debt 你要看最新的报表，应该在25左右，因为它这个季度又减少了2.2，应该是，所以它现在总体水平会是这样的，它首先要把债务减到20个 billion， 它大概还差5个 billion 不到会到这个数字，这5个 billion 它现在账上现金已经有2点几个 billion， 所以一个季度之内它如果想做肯定可以完成，所以这是首先要做的，所以这部分会比较快的完成，然后到下半年它就会开始回购，在回购的时候它仍然会把一部分的自由现金流会用于继续还债，所以在下半年可能额外的会再还至少5个 billion， 因为我们之前就是会员区应该会看到我视频讲这家公司2022年财务的推演，我说过它的自由现金流每年至少应该有10个 billion， 当然取决于油价，如果油价保持在现在的位置上，它可能一年有12、13个 billion 都有可能，所以它现在每年拿出来5到6个 billion 还债是完全有希望的，再加上另外2个 billion， 比如说发股息，3个 billion 去做股票的回购，它仍然有足够的现金，所以它的还债的速度，今年我估计应该在跟去年差不多，应该有6、7个 billion 可以完成，所以我估计它今年应该会把长期的债务减到华尔街评级机构要求它的15个 billion 左右，如果到不了也相差不多。OK， 不知道大家还有没有问题？现在是新加坡时间3点钟，准备去睡觉了。我今天晚上10点半，对会员还有一个视频，就是讲 Square 它的财报、电话会议以及回答会员们的问题。这还有一个问说，所以 Q1 和 Q2 的 priority 还是还债 ，second half 才可以 buy back。刚才就是讲的这个意思嘛，刚才说过，他很清楚，就是 buy back，不见得是一定 second half， 但肯定是第2季度以后，因为第1季度他现在那个20个 billion 的债务水平还没有达到，所以这个季度他如果比如说再有3个 billion 的现金，加上原先已经有的2点几个 billion 在账上的现金，他基本上就把5个 billion 还债就可以把债务拿到20个 billion 就 OK 了，所以我估计他的 buyback 开始可能不会早于比如说5、6月份，就是不见得一定在下半年，但可能在1季度之后。这个问说可惜短期不升不见得，这种公司你一旦长期持有就不能考虑短期的升降你要想说我看在什么时候升什么时候降，这非常困难，因为这个股市没有规律短期其实完全是乱来的，因为比如说投资机构会不会给它评级提升我们不知道就是提升到什么水平不清楚，然后整体熊市什么时候结束，牛市什么时候到来，然后公司有没有额外的利好的消息，这些其实我们都很难讲，所以你看到比如油价有时候涨得很高，它可能不动，但有时候好像没有消息，它有短时间内又会上涨很多，所以这种公司我还是之前的概念，你如果相信它应该就是长期持有，因为 我之前讲过我的那个对这个公司的思考的思路，对吧？就是如果我在，就是你如果看它的 end state， 哎，如果看它最终的，在5年之内有一个算是中期吧，这种水平，我可以非常清楚的可以想象，想象，当然这种想象是有根据的猜测，不是乱想啊。我可以想象，它5年之内债务肯定可以减到15个 billion， 对不对？这非常清楚，债务会达到非常合理的水平。然后他会开始还巴菲特的优先股，然后那个时候之所以能还巴菲特的优先股，是因为他那个时候的股息肯定已经超过$4。那如果一个公司的股息超过$4，那这家公司如果现金流稳定，它的股价应该是什么水平？水平应该是$4的大概20倍。为什么？因为一般的石油公司股票的股息率就是股息占股价的这个比例，通常在5%、6%左右。就是你买一家公司的股票，如果100块，它每年发你5块钱的股息，这就是5%的股息收益率。这种投资人就已经非常非常开心。所以如果假定同样适用于它5%的股息收益率，那如果$4的股息除以5%，返回去就是$80，这是它的股票的价值。然后认股权就应该大概在60左右，对不对？所以如果我把这个公司一下推前5年时间，就是认股权在现在的水平再翻一翻，再增加，也都是没有问题的。然后对这位朋友讲说，那么巴菲特应该也会启动他的换股债券。是的，我之前一开始的时候就讲过，巴菲特他是那种就走一步想10步的人，对不对？所以他在跟Vicky 在谈判，在把10个 billion 的钱给他做收购的时候，他自己脑子里已经很清楚算过这些同样的算术，对不对？对他来讲的话，如果这家公司股息短期有问题，经营困难，股息恢复不到，达不到$4的水平，那么这家公司会一直当他的提款机，每年吭哧吭哧来，每年给他10%的非常高的利息，对不对？所以对他来讲，他就是这个10%的收益是固定的。如果另一方面，如果公司确实这几年发展不错，迅速达到了4%的就是$4的股息，那巴菲特会启动另外一个条款，他就可以在60块、70块左右，然后就去把这些换成普通股。因为对他来讲的话，就是这两者公司效益好或者不好，对他来讲，他只是稳赚不赔。所以这是一个伟大投资者，就是让我们感到，就是他为什么这么聪明就每一个交易，每一个 transaction， 你都可以体会到他背后的考量。所以对他来讲的话，如果股息不高，他就每年10%的收益；如果股息变得很高，他就可以转换成普通股，然后持续的再拿到这些收益。所以对他来讲的话，当然都没有问题。所以这家公司就是说，如果5年之后，应该是这是很大概率的事件。如果短期，我觉得还有另外一个考量，就是你看它的自由现金流。我们讲它现在自由现金流很高，然后如果油价比较稳定，这个会持续1年可能10个 billion、12个 billion。那这12个 billion， 你不管是就3种用途，对不对？回购股票，然后还债，然后增加股息，这3种不管是什么样的方式给回到股东，这都会提升股票的价值。所以你可以大致的想象，每年的这些自由现金流就会增加到它的市值。所以这样，它现在市值好像不到40个 billion，right？ 30几个 billion。所以你3年之内就可以想象，很大概率事件是，它额外创造的自由现金流就相当于它公司的市值。所以基本上假定，基本上就是不见得会1对1的对照，但是总体来讲，这30几个 billion 的自由现金流就会把公司的市值拉高1倍。这是比较保守的判断，就是假定市场对它观点没有变化，只是由于公司自由现金流增加，做这种3种不同的手段，硬生生的把股票抬高。这当然是不可能的，因为市场随着它这些举动的展开，大家对它越来越看好这个增值肯定会比这个本身带来的30几个 billion 要大。所以 这个公司我觉得长期持有也不见得是坏事。OK， 所以我们就讲到这里，不是今天晚上，会员朋友们就今天晚上见了。OK， 谢谢大家，再见。